Welcome to the PFP Alum webinar for tax tips your accountant never told you about. We will be covering a couple of different things and going over a number of different areas with regard to your business. Now, as we go through this, not everything is going to apply to you. We know that already, right? Take what works for you and apply it. Now, one of the things is we want this to be as much like a live classroom as we can make it. So if you have questions, certainly feel free to ask, right? You can feel free to just put them in the chat box. That will work. We can certainly respond to them there as well. I've got a chat window in front of me, so I can see those and respond to you in real time. So again, and look, we just have a couple of people in the meeting. We also know that by far the majority of people who come through this program are watching the recording afterwards. And so even for you who are in the meeting, we are recording it, and afterwards we will send out the meeting to everybody who registered, as well as all other alum members as well. So with that, let's kind of jump in. And again, so if you want to ask a question in the chat box down on the toolbar on the bottom here, you'll see the chat icon. Just go ahead and open that one up, and you can use that one. Again, as a general rule, we have you muted as you come into these because we know you can't always control the sound levels in your background. If you want to talk, just go ahead and unmute yourself. Feel free to interrupt me. And then again, the chat window as we had talked about. So really, let's jump right into here. Now, first off, again, you're here because you went to the PFP workshop at one point in time. Literally, we're going to pick up. So if you've got your PFP manual handy, some of the content that we're going to be covering today is in your book starting on roughly page 128, depending on the version of manual that you have. You can actually grab that and follow along. Again, not everything will be in there, but will be somewhat close to that because we do keep updating on a regular basis. Our whole objective today as we jump in here is do a couple of things, right? Number one, lower the benefits of incorporation or take advantage of the benefits of incorporation. Find, what additional deductions might apply to you. Are there ways that you can shift income to rental and dividends if you're not doing it already today? Along with that, hopefully increasing your depreciations, using your children as tax deductions, understanding audit triggers, right? We're really looking at how can we lower our tax bill morally, legally, and ethically. Right? And again, we work way too hard. We should be able to keep as much of that as we possibly can. Now, let's just jump right in. A couple of different items. So number one, if you, as an organization, you are either self-employed or a partnership, I hate to tell you, but at that point, you pay more taxes than anybody else, and quite honestly, the rest of us appreciate it. Thank you. Because again, it's just the way that the tax code is set up. That's the way that it works. Now, if you're incorporated, right, now, a couple of different things, whether it's an S Corp, a C Corp, an LLC. Number one, you need to have an annual meeting. That's required someplace, and that meeting can be anywhere in the continental 48 as long as you're here in the States. Now, you have to take minutes of that meeting. And one of the things is that the expenses of getting to that meeting, that annual meeting for your company, is a corporate expense. Right, so every year for a number of years, when our girls were little, right, we're in Wisconsin. Our annual meeting took place in Florida. There was usually a visit to Mickey in there somewhere, and again, the cost of that entire trip to get there was a write-off. It's a corporate expense. Now, again, did we actually take minutes while we were in Florida? No, but somewhere in there, right? We were talking business as the owner of the company. You're kind of always it's on your mind, and lo and behold, when we get back, there's minutes that end up in the folder as well. So that is an area that you can use to utilize, quite frankly, take an extra deduction. Now, your corporate office can be anywhere. Right? You could have it in your home. Some of you do. It could be, a physical office space like we do here at Grandy. Again, now, if you're using your home as your corporate office, a couple of things to keep in mind there, because this has changed over the last number of years. They've tightened this up. It used to be that it really opened up a lot of stuff in your home itself. But today, they've tightened it up a little bit. So number one, if they say, or if you say that you're using your home as your corporate office, they have tightened that up to the point where they're saying, look, then you need to have a space which is dedicated to being the corporate office. right? Because for years it was, well, we always did work on the dining room table, right? And so that was kind of where things happened. Or, maybe we even have, the kids moved out and we're using one of the spare bedrooms there, right, as an office. That doesn't cut it, right? Because in your office, you don't have a sewing machine and you don't have a bed in there and you don't, right? So that no longer cuts it as the definition of a corporate office anymore. So again, it needs to be a dedicated space. Now, if you have that dedicated space, and for a number of years here at Grandy, it was actually in the lower level of my home, and we literally had a dedicated space. Those were that's where the offices were. I had employees that came in, right? That's where all the magic happened at that point in time. Now, for that, again, how you do the write-offs. Really, you work with your accountant on this one, but how you do the write-offs are basically tied to what it is, right? So, for example, number one, you do not want to depreciate the entire house, because if you do that, then you lose that deduction for capital gains if you sell the house. So that's stay away from that one. However, let's say, for example, if you paint a room. Right. So let's say I painted in the office. That's a 100% deduction. If I paint the outside of the house, well, now you get a percentage of that write-off. So, for example, in my cases, the Grandy offices occupied 18% of the total square footage of my home. And so I could take an 18% of the cost of painting as a write-off. In my case, right, I had employees who were coming there, so driveways had to be plowed every year. The utility bill had to be paid for heating and cooling and electricity, right? I could take 18% of those expenses and write them off as a write-off for the business itself. So again, it's based on the square footage of what your offices are utilizing. Again, we're not an accountant. Work with your accountant or your CPA on that one, but certainly make sure that you stay clean in that area. Another area is that technically law states that any benefits offered to one employee need to be offered to all employees. And so one of the things that you can do, right, and work with a couple of different companies who do this on a regular basis is, again, they actually set up two different corporations. Right, so corporation number one has your technicians, your office, your staff. Those individuals are in corporation number one, and they have their benefits. And corporation number two may have you and your family in it, right? And corporation number two just happens to pay all medical, dental, and education costs in the company itself. A company I dealt with just recently, again, the owner of the company, basically, he was in the corporation number two, and in effect, corporation number one, the company paid a management fee for corporation number two to manage it. And so, again, it gave a different set of benefits inside of there. So that can help and be a benefit. Now, it does mean that you need to have two sets of corporate taxes every year, or tax returns every year. Make sure that you keep that one straight. Now, this one should go, when it comes to taxes, it should go without saying. Right, use separate cars for personal and business use. And one of the reasons for this is because interest paid on personal purchases is not tax deductible. Purchases used for the business are tax deductible. And interest paid on that is a deduction. And besides that, if you start commingling, right, mixing the two together, that gets really ugly. And if you ever get caught in an audit at some point in time, that will be dug into. And so make sure you watch that when I see companies on a regular basis where, we're regularly running to the grocery store and buying groceries and using the company card. Or I've dealt with a number of places where the house payment was just simply being written out of the checkbook. Again, starts to make things really messy. The messier books are, the greater the chance of an audit, the greater the chance you're going to have a problem down the road. So again, just keep that one simple. Simply keep the expenses separate for the two of them. The next one is any auto expenses. Now, auto expenses, anytime you use a personal vehicle to run a company errand, you can write that mileage off. And I forgot to update this. All right, last year, 24, it was 67 cents. I think, if memory serves me, it's somewhere around 68, 69, right, somewhere in that range, right? Real quick Google search will find that one as far as where it's at. And again, you can go through and all you got to do is keep a log of it, right? It might be just one of those little notepads that you keep in your pocket or keep in the glove box of the car. And on May 5th, right, ran to Office Max or wherever it is, right, and 15 miles. Right? That's all you got to do. Now, here's the other thing is, again, very common, right? We might go through, my wife runs a lot of errands for the company here, and we'll actually go through, and she might be going to the grocery store, and she's, stopping, Hobby Lobby or wherever else, and then she's going to run to Office Facts for me. Well, that entire trip, right, round trip, winds up becoming a write-off. All you got to do is keep track of it. Right, and so when you start adding that up, it can add up pretty quickly because, quite frankly, if I have 2,000 miles, right, that's over $1,300 in deductions. Again, why not take it? You're already spending the money on it. Claim it. Right, anytime you're using a personal vehicle. The other one is dividends and rent. Now, again, there's no Social Security or Medicare paid or taken out of monies that the owner receives as either dividends or rent from their building, right? So in a lot of cases, company owners, right, and if you hear other company owners where, they own the building personally and they rent it back from themselves, right, or the company rents it back from them. This is the reason why. Because anything that they're paid rent, right, so I own the building, I charge my company rent to occupy that building, right? Any monies that I receive at that point in the form of rent payments, there's no Social Security and Medicare paid on that one. So if you think about that, right, if I took $20,000 a year out in the form of either dividends or rent, right, that's basically a savings of over $3,000 because again, it's $3,000, 15.3%. Is Social Security and Medicare. It's 15.3 is not only the portion that the company pays, but also the portion that me as the employer, the recipient, or the employee receives from that as well. So that can be a way to do that one. Now, here's where if you attended one of the workshops with me, and I know certainly Patrick talks about this on a regular basis as well, but in your Planning for Profit software, as the owner, if you normally take out dividends and rent, right, or if you want to, then what I always encourage you to do is go back into the labor section of the software for you, for the owner, and add to their salary the amount that they would like to take out in the form of dividends and rent. And, and again, because that way we know that we're charging enough to hit that. And I hear all the time, well, Bill, we don't take it out unless we actually have the profit. Well, if we don't plan for it, there isn't going to be any profit, right? So by putting it in under labor, for the owner of the company, let's say I want to take $100,000 out in dividends this year. Well, at that point in time, I need to add that into my equation somewhere. So that way the pricing that we establish or come up with in labor pricing for, in the Planning for Profit software is going to give me enough profit to not only pay the bills, hit my company profit targets, but also generate enough profit for me to take out in the form of dividends out of the company. So make sure you've got that in there if indeed you're taking it out. But again, this can be a huge advantage for you as well as the owner. Section 179, right? Taking a deduction for those major pieces of equipment that you're using, right? Trucks, major pieces of equipment that you've got that you're buying in the company. Again, Section 179 lets you take an immediate deduction for that business expense, right? So typically that's going to be limited to, cars, office equipment, business machinery, computers, things like that you're buying to help you run the business. Now, as you do this one, there are a couple of different things, right? So for vehicles, for example, you can write off a maximum of $500,000. Now that was, that was all put in place in Trump's first administration, where he kind of changed that a little bit. And now at this point in the One Big Beautiful Bill, a lot of that stuff, we're still sifting through it to find out what it's got. But that, again, it kind of made that permanent in there as well. So again, if the vehicle is under 6,000 pounds, that's considered a passenger vehicle, and your first year deduction maximum is $12,200. If the vehicle is over 6,000 pounds, that's now considered a commercial vehicle, right? And at that point, again, it lets you take that write-off on that vehicle itself. And so, again, we could take that maximum of $500,000 depreciation in the companies. Now, one of the things with that is you may buy a van, be able to take the write-off the entire first year, but you still have to, on paper, show that you're basically, it's 20% per year, right? So is the way they're looking at it. You can recognize it the first year. We still have to track it for a total of 5 years in there. So again, be working with your accountant on that one. The next one, using your kids as a tax deduction. Again, every child is entitled to earn just under $13,000 a year. All they have to pay is Social Security and Medicare. There's no federal tax that they have to pay on it, which means you can pay them anything you want for the work that they're doing. They just have to do some type of work for you. Right. So again, I've had, whether it's the kids be models in some of the ads, I've had other cases where, Jimmy comes in and cleans the back shop and we pay him $200 an hour to clean the shop. Right. You can pay them anything you want and they save that. Now, here's the other thing is that as a minor child, the government also said that you as their parent can basically abscond with every single dollar that they make. Right now, here's where that can be an advantage, right? I can literally write them out a check for $200 an hour for whatever work they're doing. I can now go cash that check as their parent. I can turn around and pay Jimmy $10 an hour for cleaning the shop and put the balance of it in his college savings fund, right? And start to save taxes in that way. So again, that can help you, and they actually encourage you to do that. So all these other items, right? We talked about a number of different deductions that you can use, again, morally, legally, and ethically to reduce your tax burden. Here's what the biggest thing in my mind, the most important thing, is that when it comes to deductions, be extremely aggressive. I mean, think about it. What's the worst thing that's going to happen if you take a deduction that you shouldn't have? Right, they're going to slap your hand and make you pay it back, and you might have a little bit of a fine in there. So be extremely aggressive on deductions, but make absolutely sure that you report every nickel of your income. Because failure to report your income, that's where you end up with the silver handcuffs and they take you away, because that is a federal offense. And so, again, be aggressive on the deductions, report all the income on that side of it. And so with that one, let's kind of move a little bit into a different area, and that one being the Social Security side of it. Now, we can have the whole discussion of, is it going to be there when I get there or not? Right, we can talk about that one, but here's one of the things that if you've paid the maximum on Social Security any 8 years during your working career, then you're already going to be receiving the maximum Social Security benefits that you can get, right? And so you think, okay, Bill, how do I know that? Well, again, many times on your birthday every year, they send you that little, the sheet which shows you your earning income. It's now changing where you can log on to their website, right? But once I've hit, right, and so let me just jump forward a bit there, right? Once I've looked at my earning income, right, and again, online, you can literally go through, log into your socialsecurity.gov account. You can see your earnings for every single year that you reported earnings in your working career. Now, if you also remember, when we set up your planning for profit model, we put in there for company matching taxes for Social Security, where you had to pay a certain percentage, right? You pay that 6.2% of the wages up to a certain limit. Right now, that limit, in this year, it's like $278,000 or something like that, which means for all employees, you had to pay that company matching taxes, and the employees had to pay Social Security on the first $270,000 that they earned. Well, so in reality, it pretty much means all of them. Right now, those wages weren't always so high. I mean, if I basically just zoom in on this just a little bit, I can see, in older days, those dollar amounts, those limits were much, much lower, right? Even in the 90s, we were in the 50s and 60s at that point in time. It's just more recent years that those numbers have really started to skyrocket and jump up a little bit at that point in time. So, again, you can go in and basically see how many years have I hit these maximum limits? And again, anytime you've paid eight different times in your entire, not 8 consecutive years, but any 8 times that you've hit that maximum limit, you're essentially at the maximum payout level, and it doesn't pay for you to be chunking more money in. And so what I could do at that point in time is come back to a couple of these suggestions where now maybe I lower my salary and drop that down significantly, and I maximize my spouse's salary. Right, and maybe bring that one up a little bit more. Again, how you want to handle that one is certainly up to you on that piece of the puzzle, but at least be aware of how that works. Next is audits. Right? And we hate to think about that piece of the puzzle. Now, contrary to popular belief, the IRS does not compare your tax return this year to last year to see, hey, what kind of differences are there, and does that trigger an audit? There are way over 280 million returns that they're dealing with every single year. They don't have the time or the ability to go back and do a comparison from one year to the next for each individual. That just simply doesn't happen, right? So file your taxes each year as, on their merit, the way that they actually look, right? Make sure you get that one in on time. Be proactive here on this, right? Don't, way too many companies every single year are filing the extension for taxes, and they're dealing with it in the fall of the year. Yeah, just focus on it now, right? So we have things in place so we can get it done in time. It's not worth paying the extra costs for that extension on there. Now, there are a couple of different things that will absolutely trigger an audit for you, right? And the first of those is what's called a compliance audit. Now, years and years ago, right, if you remember, every year they would literally mail you all the tax returns that you needed to fill out to file your taxes for this coming year, right? And they're also good enough to actually give you an envelope that you could just stuff your returns in and mail it back to them, right? And at that point in time, quite frankly, the best thing you could have done is thrown the envelope away and used your own, because 5% of all the envelopes were all pre-coded for an audit at random. Right? And so if you use their envelope, you increase the odds of getting audited. So throw it away, you're in better shape. Now, today, a precious small percentage of returns, both business and personal, are actually filed physically. Most of them are all filed electronically today. And so compliance audits today, they just pull those at random, and there's really not a lot that you can do to avoid it. It's the luck of the draw when you get that one pulled. Now, there's a couple of other areas that certainly apply to your business that will trigger an audit. The second audit area, right, first one being the compliance, can't do a lot about that one. The next one is the red flag system. Now, the red flag system is basically, if you recall, when you file your taxes each year, you list all of your expenses, right? And you've got them there and how much dollars you have. That's how much you're taking as a write-off, if you will, for your business. Here's the thing. The IRS has categories, and every one of these categories is based on a percentage, or they look at it in terms of a percentage. That particular category shouldn't exceed a certain percentage of your overall revenues for the company. Okay? Now, sometimes your accountant kind of creates an issue for you here, right? Because you might have very detailed information in your profit and loss statement, right? And you give that to the accountant, and they start just grouping things together. All this stuff is marketing, all this stuff, right? And they put it together. Well, now those individual areas, right? And a lot of times they do that just because they want to save forms, right? But now all those areas are each one individually is a greater percentage of your overall revenues. Now, one of the problems is they really haven't updated those percentages, in some cases, in decades. And so it's more and more common that we start hitting those limits as expenses continue to go up in our companies. And so what happens is if you get one or two of those areas where you exceeded that percentage, right, each one of those is a red flag, right, at that point, they'll probably generate a letter, or in a lot of cases, it's a card that they mail out to you, and they say, hey, according to our calculations, we came up with a different amount in taxes, and according to our calculations, you owe another $274.87. All right? And that's basically what they put it out as. And in effect, here's the thing, is they're not necessarily saying you owe the money. All they're saying is that their calculations came out differently. Yet, by sending it out, 98% of people across the nation will simply write out a check or send a check and mail it in and pay that total dollar amount in there. Now, again, they're not saying you owe it. They're just saying their numbers came up differently. Right? And so that's been one of the issues that's there. They'll gladly accept the money that anybody sends into them. Right? Now, if you have more than 7 or 8 of these categories that have exceeded those percentages, that's going to trigger a full-fledged audit. And here's one of the things is when you get the notification for an audit from the IRS, they will tell you what they want to look at. And they'll actually even be so generous is to say, look, if you want to just pull this information, send it in to us, we'll look it over and we'll report back to you with the results. You really don't want to do that, because in there you always have the ability to do an in-person audit. Now, everybody thinks, I don't want to do an in-person audit. Well, again, I will guarantee if you mail the information into them, you're likely going to lose, right? And they're going to say, yep, you owe more money, and now you have fines and things like that go along with it. Couple of things absolutely play a part here. Number one, how clean are your books? If your books are clean, the odds of coming out on the negative side of an audit go way down. Right? The sloppier your books, the greater the chance that they're going to come out on the negative side of that audit. Without a question of a doubt. If they come back and say they want a receipt, can you produce it? Right, so here at Grandy, we don't hang on to any physical receipts. We're digital all the way across the board. We're using QuickBooks for our company, for our accounting side. And literally every single expense that we have, we scan the receipt, whether it's literally running it through the quick scanner. A lot of cases for the people out on the road, they're just using their phone and scanning it. That goes in, it gets attached to that particular expense in QuickBooks. And so if you ask me for a receipt for something we bought in June of 2024 at Home Depot, we can pull you up the receipt in probably about 2 minutes and print a copy of it. That's where you want to be. Right? Now, here's the other part of it. I know just as many companies who have been called in for an audit, right? Who, it doesn't necessarily mean it's a bad thing. It means they're going to go through the numbers. And is it kind of a pain? Yes. But it doesn't necessarily mean that it's going to cost you a bunch of money. If your books are clean, right? Again, I know just as many companies who have gone into an audit, done the face-to-face audit itself, and coming out of it at the end that going, yep, you owe more money, right? There are certainly a group of those. I know others where they're going, nah, we're good. Right? And I've got a good example of that. A friend of mine who owned a very large plumbing and heating company got his audit. They wanted him to send in information, and he said, nope, I'd rather do it in person. Right, and so, and again, his books were very clean. There's no question about that. He keeps very detailed records on everything they're doing, on their jobs, their expenses, all the way down the line. And so he literally goes for his appointment at 9 o'clock in the morning, right? And he's walking in the door of this office building with a hand cart with 3 banker's boxes stacked up on top of it. And he's rolling this stuff in, and there's a guy going up the elevator with him, and he looks at him and he goes, "Are you my 9 o'clock?" Bill goes, "I probably am." Right? They get in there, they start looking at it. Bill pulls these banker boxes and throws them up on the conference room table, and literally the auditor went through it. He stopped, he pulled, kind of went through one of the boxes, pulled out some information, asked Bill a question on it, stuffed it back in, went in. He did that about 4 or 5 times, and literally in about 7 minutes, he goes, okay, we're good here. Because it was absolutely evident by the amount of detail that Bill kept, the way that he kept it, his level of organization in his records themselves, the odds were they weren't going to find anything. And so, again, the cleaner your books are, the more organized your records are, the better off you are. Then, so that's the second third, right? Some of them had to pay, some of them were just good. And I know equally as many people that went through the audit and got to the end of it and found, they basically said, we owe you money. Right? And they actually got a greater refund after the audit than they had before, right? So the important thing is keep your books organized, keep them clean, keep the separation between personal and corporate as clean as you can, right? Because when they start finding those things, then all of a sudden we start to have a little bit of an issue. And again, that can go all the way through the company itself. I had one particular company I worked with that as I'm working with them, they were starting to think about selling the company. And I'm looking at their finances and we see their retained earnings, and they had this huge dollar amount in their retained earnings. And I'm going, so you must have a fair amount of liquid cash here somewhere. And they're going, no, we don't have anything. Right? And I questioned him a few more times. And as we started really unpacking and unpeeling the onion, what we find out is they actually went out and bought a lake house. They took a bunch of cash out of the company and bought a lake house for their retirement. Well, now, the question you have to ask at that point in time is then who owns the lake house? Is it me personally or is it the company? Because if it's you personally, you never paid any taxes on the money that you took out of the company to buy the lake house. So we have an issue there, right? And if it's the companies, well, now if you sell the company, you lose the lake house and you got to buy it, right? So make sure you keep things clean. Don't get yourself in trouble. The third trigger for an audit is what's called an economic reality test. And this, odds are you don't have to worry about. If you do, I might want to be your new best friend, right? But it basically says that you need to just show that you earn enough money to support your lifestyle. Right? And what they do is they're basically looking for a 5-to-1 ratio of your income to your mortgage expense, your property taxes, your personal property taxes, that you earn enough money to be able to pay for that stuff. Right? Yeah. And again, if you're paying $100,000 a year in taxes, you are not earning $125,000 a year. Right. These are people, ball players and musicians and people who are making incredible amounts of money. That's what they're looking at in this piece. Now, there is still the National Research Project, which was put into effect a number of years ago, is still in place today. Again, this whole issue of the 86,000 new IRS agents that were brought in through the Biden administration, and then they were fired. And then I read something last week, they're bringing some back. I mean, so who knows what's going on with them? But a lot of this was all to kind of focus a little bit on this piece of the puzzle. And what they're doing is they're doing an in-depth audit on several thousand small businesses each year at random. And the goal is to find out how well are they complying with employment and tax regulations. That's the goal. And so as we look at this, there's really a couple of different focus areas. The first one is worker classification. And this is one, out of all tax items I deal with, this is probably the one I have the most conversations on. Are they an employee or are they an independent contractor? Right. And again, we run into this situation where there's a lot of companies that they'll have people working for them and they basically say, well, they're an independent contractor, which means as the employer, I don't have to pay any company matching taxes. I don't have to give them benefits. Right. That's all theirs. Right. I just pay them the fee that they have. Well, it's not as clear as just simply saying, hey, I'm an independent contractor, or that individual is an independent contractor. There's a kind of, and the challenge is it's a gray area. But here is the thing. They're going to ask a couple of different questions. For example, who finds the work, right? Do they find the work or do you give them the jobs, right? If you give them the jobs every day, they very well may be an employee, not an independent contractor, right? And so you can say, well, yeah, but I give my employees jobs too, right? But here's the thing. Do they only work for you or do they do the same type of work for other companies or other individuals? If they do work for other individuals, well, that's, at that point, that in itself holds a lot of weight as far as their being an independent contractor. But it's not the sole one. Right? If the majority of what they do is for you, they may be an employee. Who gives them, or how do they get their tools and the things they need to actually do the work? If you provide them, they're probably an employee, not an independent contractor. Do they drive your truck or do they provide their own vehicle? If they're driving yours, they're probably an employee. Right? Again, who provides the materials and equipment that they're installing? If you provide it, they're very likely an employee, not an independent contractor. Right? And so a lot of these things start to factor in. The problem is it's somewhat subjective, and we don't always win. Now, here's the problem is if you have individuals that you're classifying as independent contractors, and they come back and they deem that they are employees, well, at that point, you now have to go back and pay all the company matching taxes since the day that individual started working for you. And since you were late, there's also fines and penalties and interest that they're going to tack on top of that. I have dealt with a couple of different small companies that had their individuals worked as independent contractors, or they paid them cash instead of giving them a paycheck and withholding taxes. Either way, it gets you in the same boat. And at that point, they ended up with fines and penalties well into six figures. And for a small company, that's going to put a ding in your cash flow. So that's one of the first areas. Again, make sure that you've got them classified correctly. In most cases, they're going to be employees. Second one is going to be executive compensation. In other words, what is the owner of the company? What's everything we're taking out of the company, whether it's salary, non-salary compensations, loans the company is giving me, deferred compensation, stock, anything else that we're taking out. Are we accounting for all of that? And are we paying taxes on everything that's coming out of the company? Next one is fringe benefits, right? What are the perks that we have? Right, and this was kind of frustrating. I mean, I remember years ago where, as a manager or something, I'd keep gift cards in my desk drawer all the time, and I'd reward employees with that. Well, technically, right, they're saying that's income, and you need to pay company matching taxes, and they need to pay taxes on it. Christmas bonuses, same thing, right? If you give out a Christmas bonus, do you give it in a check? Because technically, anything you give out in the form of a Christmas bonus, there needs to be withholding. There needs to be company matching taxes paid on that one, right? And so I've done it both ways. In my company, I've had years where I've given the team cash. And what I did at that point, in all reality, is I took the wages or distributions myself. I paid the taxes on it and then turned around and gave the cash to the employees. There's other cases where I would actually just gross up, right? In other words, I wanted to give a check for, let's say, $1,000. I would actually gross it up. So literally we'd calculate what are all the matching taxes that need to come out of this thing, the employee taxes that come out of it, so I can have a net check, a net pay of $1,000. And so again, that's another way that you can do it. But again, they want to see that you're being detailed on that one. And then also along with that one is, again, payroll taxes. Again, that's your 941s and 1099s, W-2s, that they're all clean, they're accurate, and that we don't have any delays in there. So all of those areas can get you in trouble. Make sure that you stay clean with that one. Now, again, if you think about it, what are some things that you could do to actually lower your tax burden? Right? How can you lower them morally, legally, and ethically if we have all these other items out here that tend to get us in trouble? Right, now, we've got a small group here, so I won't make you guys chime up. But for example, and if you remember, right, and I just want to see my, if you remember in the workshop, so Richard, right, charitable contributions, absolutely. No question about it. That can be a way that we reduce it. But so if you remember, when we talked about the cash flow in the workshop, one of the things that we talked about was, the end of the year, right? The accountant's looking at your numbers and they're going, man, you ought to go spend some money. You're going to get nailed with taxes. Right? And so, again, at that point in time, I was working for a wholesale distributor, and we, November and December, see all these brand new shiny red pickup trucks backing up to the loading dock. And then those same companies were now 30, 60, 90 days, they were past due with us. Well, again, firsthand difference between cash flow and accounting. But here's the other thing. They were buying the truck so they could get a deduction or a write-off. Right? And so that was one of those items that was, that's an issue. Julie, I see the loan prepayment or repayment versus W-2 income. Remember that anything that goes toward principal in your loan payment is seen as profit. And so literally, right, if I've got a $10,000 loan hanging out there and I've got more, a bunch of, did pretty well this year and I put $10,000 and pay that off, all that principal that we just paid off is all looked at by Uncle Sam as profit. So you can't take that one as a write-off. Now, any interest that you pay is a deductible expense, but any principal is seen as profit. So that one starts to get you in trouble. And I used to get in trouble on that one. In that, again, I tend to be debt averse. And so when I'd have that, I'd had a really good month and I'd go ahead and I'd pay down as fast as I can on the principal of those loans. And then I get to the end of the year and Uncle Sam's going, hey, great year, right? Because all that principal I paid was profit. And now I had to come up with the money to pay the taxes on all that profit. So that one didn't help me. And so I'm going to give you a way here in just a little bit that I fix it. A shareholder loan, got it. That makes sense at that point. So a couple of other items that you can do is what about prepaying expenses for next year? For example, if you've got a job that you're going to be using equipment on in the first couple of months, maybe I prepay for that inventory. I buy it in December so I can use it then the next couple of months. Remember, if you're cash versus accrual, right? Accrual means that we recognize the cost or the expense when we get the invoice or we enter the invoice. Cash basis accounting isn't going to recognize that until we actually pay the invoice, actually write the check. And so depending on the setup of your company, make sure you're accounting for that time difference that's in there. Now, so I could prepay inventory. What about prepaying expenses? Maybe prepaying an insurance expense. In our case, the platform, the expense of the platform that we use for these virtual programs that we do is expensive, right? If I can, I will pay the entire cost of the following year in December. It enables me, because think about it, it does two things for me, any one of these items, right? It enables me to take a write-off and lower my tax burden. At the same time, it helps me, it reduces my cash flow drain throughout the course of next year. I don't have that monthly payment every year next year. So doing things like that, prepaying expenses, prepaying advertising, prepaying training. Right? That's an area where there's organizations or companies, right? If you wanted to come to me and say, Bill, we want to do and we get companies who do this, we want to do a certain amount of training. I want to do $5,000 of training next year. Can I pay you for that in December? Yes, you can, right? And at that point in time, you have a paid receipt for that. It's a deduction that you can take, and now it entitles you to dollars that you have to be able to use coming up. And there's a number of organizations that will do things like that. The one that comes up, and I get asked about it all the time, is what about rent or mortgage payment? Well, we talked about the mortgage payment a little bit, right? So that one doesn't help you. Rent, IRS says you can't take a write-off for rent until you actually recognize that month, right? So, for example, I haven't occupied the building next June, so therefore I can't take a write-off for next June yet, right? So I can only recognize the write-off for the month that it was actually paying for. So that one doesn't help. But all those things will absolutely help you reduce your tax burden while helping your cash flow moving forward. Now, this does get into that case, right? So, debt reduction is the piece that I was talking about. And again, we see companies who try and work at getting out of debt. Now, depending on when you attended the workshop, you know that, again, in the current model, we added in there the debt category section. So, in other words, for a long time, forever, we just had you enter in any loan payments as a fixed overhead expense. Now we have a separate debt section in there, so you can move it. If it's still in fixed overhead, encourage you to move it down to the debt category. What this does for you is it lets you see the impact of that debt, how much it's taking from your company. Now, as we look at this and start to factor this in, it's not uncommon that we have companies that $75 out of every single hour they're billing out throughout the course of the year is going to cover loan payments in the company, right? And so, again, it's not if things slow down, it's when they slow down. Those companies that are least leveraged are going to weather that storm the easiest. And so, then we start talking about that issue that I would have, right? I'd go ahead and I'd pay down debt. Well, then at the end of the year, it's all seen as profit. And so then I had to come up with money for taxes. And so here's, again, remember that difference. And this is the example that we had in class, the cash flow versus accounting. Right, if I had $800,000 in total sales, right, small company here, right, we did $320,000 in total materials, $160,000 was my labor. We have depreciation on those loans on my equipment of $20,000. We had interest on loans of $6,000, and then all other overhead costs combined were $280,000. Right, again, I tally that up, and that's a $14,000 profit. This is exactly what I was getting to on that debt piece of the puzzle. But from a cash flow perspective, right, I actually go through and it's same sales, same cost of materials, same cost of labor. Instead of the $20,000 in depreciation, my actual equipment replacement costs are $35,000. Remember, for the typical trades company, your actual equipment replacement costs are 25 to 35% higher than the depreciation that will be listed on your P&L. So we're already underreporting what it's costing you to run the company. And then instead of $6,000 in interest, our actual loan payment was $24,000. And then all other costs combined are exactly the same. And so at that point, you do the math on that one, we didn't have a $14,000 profit. We actually had a $19,000 loss, even in this little company. Now, again, remember, even though the checkbook is saying minus $19,000, Uncle Sam is going to come back and go, nice job. You made $14,000. You get to pay taxes on the 14. Excuse me. So how do I reconcile that piece of the puzzle, right? How do I get around that? Now, I'm just going to share with you what we did in our company. And part of it was I had to protect me against me, right? That desire to get out of debt. And so here's the way that we did it. This is what we do every single month, even to this day. First off, we will go through and we'll run our P&L from a cash perspective. All right, even if you're on accrual, we'll run it from a cash perspective. And so very simplified, right? That's right here. We have our total income, we have our total expenses, and then we have our net profit at the end of our P&L. All right, and so my example, $68,000 in this time frame. Now, the problem is that's an accounting profit. It's not a cash flow net profit. And so we're going to take that number and we're going to make adjustments to it. And so the first item, right, what are my equipment replacement costs, right? And so if you look at your monthly cash flow report in your software, you can see for all departments how much is your equipment replacement cost. In this example, it was $1,500 a month. We literally take that, move it over into a separate equipment replacement cost savings account, and I subtract it from my profit. If you have a line of credit, we want to put dollars in there to reduce that line of credit. In this case, we've made a $3,000 payment on our line of credit. I'm going to reduce that because that doesn't show up. Any of that principal doesn't show up as profit. It shows up as profit rather, right? And then we also had another loan out here that we made a payment on. The principal portion of that was $2,479. I'm going to subtract that. And then I'm making a payment into what I call my Hill and Valley account. All right, we'll talk about that in a second. And so those are all non-tax, they're non-cash adjustments in a lot of cases, right? They shows up as profit when I run my P&L. So I'm going to take all those items, right? That's another $8,500, and I'm going to subtract that from my accounting net profit. My actual net profit, my cash flow net profit was $59,000. That's the profit that I'm going to work with within my company. Now, here, a couple of things here. First off, what do we do with that profit? If you leave it in the checkbook, the law of money says any significant size budget can and will absorb every dollar that you make available to it. And so it will go away, right? And so what are we going to do with it? I want to be very intentional. And this is how I handle it. So in my case, whatever that cash flow net profit was after we made adjustments, I'm going to put 5% of that into a profit sharing pool for my team. Right? Because again, I know the reason that we were profitable as a company is because of the work of every individual on my team. And so I'm going to share some of that with them. And I do that every month. Now, there's some months, here, let me back up, one other item, right? So that's the total pool, and then that'll be split up between individuals. Now, within your companies, I've dealt with companies that have done it 100 different ways. I don't want to have to sit and think this month, okay, how am I going to split up that $2,900 amongst my team? Every person on the team has a percentage of the pool, right? And so I work with some companies that everybody on the team gets a part of the profit sharing pool, right down to the person that started here, 3 months ago, right? Everybody gets a percentage. Now, maybe not all equal percentages, but they all get a percentage of it. I've dealt with other companies where it was the management team that benefited from the profit sharing pool. Do it however you want, right? But reward your team for profitable months. That's the first piece. Then the remaining 95%, I'm going to take 40% of it and I'm going to put it toward debt reduction, paying down loans. Right? I'm going to take another 40% of that and I'm going to put it into my Hill and Valley account. Now, if you remember, I already made a payment into my Hill and Valley account. This is above and beyond that. I planned for that regular payment in there just to put money aside. But the Hill and Valley account now starts to get into what am I going to do? What am I going to do with when I have a slow month? When I have a month where I don't make money, now what? Okay. Well, a couple of different things, right? How am I going to pay my bills? I still want to stay current on those. What about if we have a downturn in the economy? How do we keep the ball rolling? Right? That's what the Hill and Valley is really for at that point in time. So in our case, we are very quick to put money into Hill and Valley, and we are really heavily resistant against taking money out of it. We're going to miss a bill, paying a bill on time, before we're going to miss a Hill and Valley, pull money out of Hill and Valley account. So that can absolutely help. It also builds a pool of money, so when I have to pay taxes at the end of the year, I've got monies there for that. Goes into there. Now, again, you can adjust these percentages. This is just what I use. The 5% profit sharing, we've had months where some of the team members have received some really nice profit sharing checks. We've had other months where they've received checks for like $10.37. And we've had other months where they don't get anything because we lost money. And again, that is just, it goes along with the company itself. And again, I've had people ask me the question on that one, well, what do you do when you lose money? Well, again, you only shared 5% of the profit. You kept 95%, so if you handle it, you're going to be okay, right? So just kind of plan for those couple of items. This is how we took care of it, how we addressed it on our side. Just a suggestion for you. Now, couple of different things as we kind of come to the end here and start to land the plane. I just want to make, again, if you haven't seen the initial announcement, we have a new integration in the software with QuickBooks Online. If you use QuickBooks Online, this is awesome. It really, because again, if you remember, when you came to the workshop, we had you print out your profit and loss statement for the last 12 months. And so with this integration, you no longer have to enter in all of that data. Let me just show you real quick. So we put out an announcement about a month or so ago about phase 1 of this integration. Our phase 2 is now complete as well. So let me just give you a real quick look at what that looks like, right? So I'm just going to go over to the software itself and I'm going to log in as me. Right? Now, here's the way that it works. And it's already there. So if you have an account, you've already got this available to you. Right? So Julie, I'm seeing that would be great. Let me show you how this works. So the first thing you're going to do is once you set up and you've got your company already here, you're going to click on the little icon and we've got we're catching. Let me move that here a little bit out of the way. There we go. Right. So you're going to click on your little emoticon or the icon right up there in the corner, the little person. Right. So when I click on that, one of the items that you're going to see is settings. So you'll simply go into settings And this is where it shows you, right? If we make that a little bit bigger, that's where you can see, how you're logged in. You can see, you change your password, your subscription information, that sort of thing. You will now see QuickBooks. Okay. So when I go in there and click on QuickBooks, what it's going to show you is your company, right? So in my case, I've got a whole bunch of companies that I test with and play with inside of there. But you're going to see them at that point in time, and there's going to be the red Connect QB box there. You'll simply click on that icon, and what it's going to do is literally, and again, I'm logged into another account, but I'll just simply click on this one here. What it's going to do is it's going to go out and ask you to log into your QuickBooks. Okay, so again, I'm going to step back because I'm already logged in. Now, you're simply going to put in your username and password to log into QuickBooks, and then at that point, it's going to change to a green bar there. The green bar says you are connected to your QuickBooks, and you can disconnect it at some point in the future if you want. Once you've done that, here's where the magic starts to happen. So I'm going to go over to cost input. And this applies to fixed overhead, variable overhead, and subcontractors. And let me show you how it works, right? So when I go into fixed overhead, and I'm going to enter in a new expense. So I'm going to click on the Add New Overhead Expense in the corner. All right, so if I blow that up a little bit, you will notice at this point now, the fixed overhead description now has a drop-down arrow next to it. And when you click on that, what you're going to see, that is your chart of accounts from your QuickBooks Online account. Now, if you're using desktop, doesn't work with that. This is just the online side, right? So I can literally see I've got my general ledger numbers if you're using them, the description, and then also how much you had total in that particular category last year, right? So I might say, okay, this is going to be bank service charges. Right, so I'm going to grab that one. What it's going to do is it's going to bring in that item, right? So you see it automatically filled in your description. And then the other thing it's going to do is let me get out of your way here. It's going to fill in the exact dollar amount for the last 12 months all the way down the line. So that's already there. All you got to do is pick the item off the list. The only thing left to do, right, is how are we going to apply the cost? Right now, again, it's going to change it to manual on you automatically. You just leave it there. And the reason it's doing that is because it's putting the dollar amounts in over here on the right-hand side. So all you really need to do is scroll down, choose an allocation method, and you're done. You accept this one, and it's good to go. Right, so it makes the entry, first off, a lot easier. Second thing that you can use this for is some of you, can you set a fiscal year? No, Julie, the software is working January through, it's January through December. But now, so even now, when I go in and select that particular expense, it's not pulling a calendar year, it's pulling the last 12 months of expenses. Because here we want to make sure that your labor pricing is still accurate, so we want to pull actual data for the last 12 months. Now, having said that, it's going to pull 12 months, right? Because again, as I'm in here looking at this particular expense, I love these questions, Julie, right? Again, you're filling in the months of January through December, so it's going to pull in the last 12 months of expenses. So you've always got the most recent information. So that's where this can help you, right? So let's say I put my model together last month. This month, I can now come out here and I can go right back into this item, simply choose that same item off the list. It will go back and update all these figures for now the last 12 months, right? So before last month when I did it, I was getting, basically July through the previous August. Now when I do it this month, I'm getting August through the previous July. So it's really easy to keep that information always current. You can be looking at your pricing. Is what I'm charging today still in line? Okay, so that's phase one. Again, that works. It works here in fixed expenses. You've got the same thing in variable expenses. When I add a new expense there, you've got the drop down. And it works for subcontractors. Right? So those three areas all have that drop down available to you. All right, so that is in there. Now, I'm going to share with you, because phase 2 is completed as well. We've got a couple of bugs that we're working out of it, but phase 2 is already there as well. So one of the things that we always taught you is that, okay, when you're done with your model and you have it all set, that monthly cash flow report that's there is your monthly cash, right? That is your budget. That's your cash flow budget right there, right? And we were asked all the time, well, can we put this in QuickBooks? And so we have two issues. Yes, Julie, this is all in place today. If you go look for it, you're going to see it's all there. So again, all you got to do is go into settings, connect, log into your QuickBooks account. You'll see it. And so the second piece of it is, how do I push this budget, this cash flow budget? How do I get that into QuickBooks? And prior to this, we'd tell you, we always recommended go in there, choose all departments, right? And when you chose, now it's giving you a cash flow budget for your entire company. You're going to choose all departments and print this off and go enter it into the budgeting tool in QuickBooks. And now you can let QuickBooks do what it was designed to do. Every month you can run a budget versus actual report and see how close to your budget you actually were. We can make that a little bit easier, right? So now, first off, when I go into this report and I go to all departments, I'm simply going to scroll down to the very bottom of this report, and you're going to notice we have an icon here now that says, and this is only under all departments, push to QuickBooks budget. Now, if you don't see that, what that means is you've got some of these line items that don't match up, that Planning for Profit doesn't know where to put it in your QuickBooks. Right? Now, first off, anything that you picked, for example, in cost input, when you selected, you hit the drop-down area and you chose it off of your list, it knows where to put that. It's going to put it right back to the same place. But for things like, for example, your income, it doesn't know where to put that, right? Indirect labor, doesn't know where to put that, right? Because we have that built into the reports. And so what you're going to do at that point is, again, go back up to the little icon in the corner, and you're going to go back into settings, right? Back to QuickBooks on your menu. And again, remember the second item. You got the one green bar that said you're connected. The second one here, if I blow that up, simply says map accounts. So when I go into map accounts, first thing it's going to do is it's going to ask me, okay, what year are you creating this budget for? Well, my model here is for 2025, right? So I can just choose 2025, right? And so we're going to create a budget in QuickBooks for 2025. Okay, I'm going to hit continue. Now what it's going to do is it's going to show me every single account that I have in Planning for Profit, and it's asking me, where do we want to map that to what general ledger account do we want to map that to in QuickBooks? Now there's a whole bunch of them, and again, mine is kind of a test account, but you will see some in there that are actually grayed out. Those are items that you literally picked from the list when you were doing your cost input. And so it's going to put it right back into that same account. Other items, what it's doing is you have to select it. You hit the drop down. Again, it's going to show you your profit and loss statement, and you can pick that particular general ledger account. Now, two things to keep in mind, and this is a little bit of the cleanup that we're doing because this is already in your model. The cleanup that we're doing is, number one, we're getting them to sort this list just like your P&L is. Right? That's the way it should be. Somehow it got jumbled up. So right now you kind of hunt through it and find the general ledger categories. That's the first thing. Second thing is, once you start this process to map these accounts, you have to go all the way through. I can't save in the middle and leave some blank. Right? And so the very next thing that we're doing is give me the ability to save it, even though I only got some of them done, so I can work on it a little bit, go back there. Is there an exception report? Actually, it's very, very simple in that literally when I come in here, if it's not mapped, right? So let me just blow that up a little bit, right? So let's say total income. If that were not mapped, this field would just be blank. And all you would have is a drop-down arrow on the right-hand side. That's it, right? If there's something in that box, it's mapped, you're good to go. Once you get them all mapped all the way down the list, then what you're going to do is you're going to save it. Right, so I'll save those mappings, and it's going to confirm that we did indeed save it. All right, I get the green bar in the corner. Now I can go back to my reports, my monthly cash flow, and I'll go into all departments, scroll down to the bottom, and I can push to QuickBooks budgeting. Oh, I'm standing in front of you, right? So when I push it to QuickBooks, it's telling me at this point that it's pushing to QuickBooks budgeting. Now, here's one of the other items that's there, is that we put this in place. We literally pushed it. We were testing it on staging. Everything worked perfect. We went into and pushed it to live a week and a half ago, and Intuit made a change with their QuickBooks Online. And what they changed is that, so there's 4 different levels of QuickBooks Online. And it's the basic does not have the budgeting tool. There's the level number 2 does not have the budgeting tool in it anymore. It's just the QuickBooks Online Plus and Advanced, the 2 top versions that have the budgeting tool in it. And so if you go through and you don't have it, it just simply gives you an error message that it couldn't push to your QuickBooks account because there's no budgeting tool active over there. So again, if you log into QuickBooks and on the menu on the left-hand side, you can see budgets, then you have budgets available to you. And it will push over to there with that. So those are in place. Again, we got a little bit of cleanup on this pushing it back to QuickBooks, but we're basically certainly there. It definitely works well, and saves a lot of work on that point. So any questions on that one? And again, Julie, you've been throwing me a number of questions as we went through there, so I appreciate that. If you have any questions as you start playing with it and digging into it, call us. Let us know. We will absolutely jump in and help you with that piece of the puzzle. So that's already there. It's in place. It's ready to rock and roll. The other one I just want to give a quick shout out to is our Contractor Academy. Contractor Academy, now if you are on the HVAC side, we have somewhere around 70 different courses, well over 250 lessons. If you were to sit down and go through all of the on-demand training in Contractor Academy today, will take you somewhere around 70 hours of time. All of it is interactive. It's not just videos, so there's knowledge checks as you're going through it. There's quizzes at the end, right? If you want your company or somebody in your company to go through it, you could sign up with a block of 5. Literally, the pricing is $29 per person. Right, as I go up from there, that's the most expensive it gets. It's $29 a person. If you want to do a block of 5, for example, for your team, or a block of 10, we'll make you the administrator. You dictate who has access to it within your company, who doesn't. You can see their progress. You can see how which courses they've completed, which ones they've passed, what their test scores are. You have all that available to you. Check out Contractor Academy on our website as well. So with that, kind of brings us to the end of our topic today, our PFP alum session. Again, we have been recording it, so we will be sending you out a link so you can rewatch it if you have questions as we go through there. And with that, guys, stay safe, stay healthy. God bless you. Take care.